The 7 accounts that will make you wealthy. Hi everyone, I'm Ava, and welcome back to your financial journey. In the world of finance, navigating all the different terms and accounts that you come across can be pretty confusing. And that's why in today's video, we'll be talking about the 7 types of savings accounts for building your wealth. Savings accounts, retirement accounts, and a more recent, newer type of account you may never have heard of. Now, putting money in any of them won't make you wealthy instantly, unfortunately, but these accounts are the building blocks for a strong financial future. If you know these 7 accounts and use them correctly, it will supercharge your wealth building journey and set you up for success. We'll talk about what each account is, what it's used for, and the role it plays in your financial journey. Let's get started. 1. Checking account. Let's start with the foundation and command center of your finances, the simple checking account. This is like the door to your money. It's where your paycheck lands, your bills get paid, and money is moved into other accounts later on. Checking accounts are the basic bank accounts designed to give you easy access to everyday transactions, like depositing money, writing checks, or using your debit card. Checking accounts are designed for liquidity and convenience, not to make you money. Because in return for a bank holding your money securely, you get paid usually under 0.1% if you earn any interest at all. The mistake people make is treating their checking account as their everything account, for savings too, letting their money sit there instead of having it work for them to build wealth in the long run. The key is to use your account wisely. Keep 1 or 2 months of expenses in your checking account and move the rest somewhere else. And look out for potential fees too, like a maintenance fee, overdraft fees, or ATM fees. And if you find the right checking account, you could get no monthly maintenance fees, free or reimbursed ATM withdrawals, and strong online and mobile banking features. So while the checking account doesn't directly make you rich, it serves as the crucial hub that helps keep your cash organized. If you don't use it wisely, it could lead to fees and money sitting idly. But if you do use it wisely, you can use it to efficiently manage your money or channel it elsewhere. And that brings us to our second key account. 2. High yield savings account. A high yield savings account is a boosted savings account with an APY, or annual percentage yield, that's usually around 4% at the time of this taping, or maybe even a little bit more depending on the bank you're with, rather than the under 1% APY you might get in a regular savings account. While your checking account is for daily transactions and spending, a high-yield savings account is for putting money in a place where it can grow, but where it also stays available for you in case you need access to a few extra dollars. High-yield savings accounts are typically used for short-term purposes. Most importantly, for an emergency fund that covers 3 to 6 months worth of expenses, but also for things like a vacation fund or future down payment on a car or house. It's not for daily use though, and many accounts limit the amount of withdrawals per month, usually to somewhere around 6, to encourage you to save. In a high-yield savings account, your money grows with interest that's compounded daily or monthly. With an APY of 4.0%, $10,000 in a high-yield savings account would earn you around $400 in interest in a year, versus just $100 if that money were in a traditional 1% savings account. So make sure to look around different banks and brokerages to find the best possible rate you can get. The key here is not only to use your high-yield savings account to build up a short-term safety net, but also to not get carried away and put your long-term investments here. Because while a high-yield savings account provides safety and flexibility for the short term, the interest rate on a high-yield savings account is not fixed for the long term, but variable, which means that the bank can change it at any time it likes. But growth is what builds wealth over decades. Which brings us to account number 3. 3. 401k. Once your safety net is in place, you can focus on building long-term wealth. And one of the best ways to do that is with a 401k. A 401k is an employer-sponsored retirement plan you can contribute pre-tax dollars to, allowing your investments to grow tax-deferred until you withdraw them in retirement. You can't open a 401k on your own, but need to be employed by a company that offers one. Contributions come directly from your gross salary, which lowers your current taxable income on the paycheck. And in many cases, a 401k might include an employer match, in which your employer offers to match every dollar you contribute to your 401k up to, say, 3 to 6% of your salary, though the details will vary. Contribute at least enough money to get your full employer match. That's the closest thing to free money you'll get. And maximize your total contributions if you can. For 2025, for those under age 50, the employee contribution limit is $23,500. If you're age 50 to 59 or 64 or older, you're eligible for an additional $7,500 in catch-up contributions. Also, note that starting in 2025, those between ages 60 and 63 will be eligible to contribute up to $11,250 as a catch-up contribution, if your plan allows this. This means those 50 to 59 or 64 or older will be able to contribute up to $31,000 in 2025, and those 60 to 63 will be able to contribute up to $34,750 in 2025, if your plan allows. Check with your plan sponsor to see what catch-up contributions are available to you. That money can be invested in stocks, bonds, or funds, depending on what your 401k offers, and it grows tax-deferred until you withdraw it at 59.5 or later. If you withdraw money before that, though, you'll have to pay income tax and a 10% penalty on top in most cases. That's because 401ks are intended for long-term retirement savings, which also means you should prioritize them early, because the more time your money has, the more it will compound and grow. But other accounts provide tax benefits too. And that brings us to our next one. 4. Health Savings Account or HSA. If you qualify, the Health Savings Account or HSA might be the most tax-advantaged account you'll ever own. HSAs are only available to those with high deductible health plans. But when you have one, at a federal level, the HSA is triple tax-advantaged. Contributions are tax-deductible, your money can be invested and grow tax-free, and withdrawals for qualified medical expenses aren't taxed either. The state tax treatment of HSAs varies though, and some states don't fully conform to the federal tax treatment. That means they may tax HSA contributions, earnings, or both. The two states that most often come to mind are California and New Jersey. So make sure to check the latest tax regulations in your state to confirm what they say about HSAs. HSAs, as you might have guessed, are used to save for things like doctor visits, prescriptions, and other medical expenses. You can use the triple tax-free money in an HSA as soon as it is in the account. However, there are no time limits on an HSA, which means you can also put money in now and let it grow to help later with healthcare costs in retirement, which are often one of the biggest expenses you'll face. In 2025, you can invest up to $4,300 for self-only coverage or $8,550 for family coverage. And after age 65, you can withdraw money for any purpose without penalties, though non-medical withdrawals are taxed like a traditional IRA. Many people treat their HSA as a retirement account and pay medical bills out of pocket while they're still working, allowing their HSA to grow. But be aware that if you withdraw money before 65 for non-healthcare purposes, you'll have to pay income tax plus a 20% penalty. Still, assuming you don't, the triple tax benefit nature of HSAs means there's more money to compound, so investing early lets you build more wealth in the long run. And so does account number 5. 5. Roth IRA. A Roth IRA is an individual retirement account that, like a 401k, is meant for long-term savings. But unlike a 401k, you contribute money you've already paid taxes on. That might not sound great at first, but in reality, there are a number of advantages. 1. You can withdraw your Roth contributions tax-free, again, because you've already paid taxes on it. 2. Your investments grow tax-free. And 3. Qualified withdrawals in retirement are tax-free too. That gives you much more flexibility with your money, especially if you expect to be in a higher income bracket in retirement than you are now. Note, though, that for a withdrawal to be considered qualified, the 5-year aging requirement has to be satisfied, and you must be age 59.5 or older, or meet one of several exemptions, such as total and permanent disability, a qualified first-time home purchase, or death. If you'd like to learn more about the 5-year aging rule, drop a comment below. And if you want to learn how to set up a Roth IRA with Fidelity, Schwab, or Vanguard, check out these videos here that I've linked in the video description below for you. For 2025, you can contribute up to $7,000 a year to a Roth IRA if you're under 50, and $8,000 if you're 50 and over. However, there is an income limit for a Roth IRA that's based on your Modified Adjusted Gross Income, or MAGI. If you're single with a MAGI below $150,000, you can make the full $7,000 contribution to your Roth IRA if you're under 50, and the full $8,000 contribution if you're 50 and over. If your Maggie is between $150,000 and $165,000, you can make a partial contribution. And if your Maggie is $165,000 or more, you can't make any contribution at all. If you're married filing jointly with a Maggie below $236,000, you can make the full $7,000 contribution to your Roth IRA if you're under 50, and the full $8,000 contribution if you're 50 and over. And your spouse can do the same. If your Maggie is between $236,000 and $246,000, you can make a partial contribution. And if your Maggie is $246,000 or more, you can't make any contribution at all. The good news is, if you're eligible for a Roth IRA, you can even combine a Roth IRA with a 401k. And because earnings grow and can be withdrawn tax-free, Roth IRAs are particularly powerful for high-growth investments like stock index funds and ETFs. For example, if I were to max out my Roth contribution every year for 30 years, assuming that the annual contribution limit stays the same as it is currently, at $7,000 per year, and also assuming that I invest that Roth money into the S&P 500 with its average annual return of around 7% after inflation, I could have over $711,000 in 30 years. I don't know about you, but that's a lot of money in my mind. So by investing early and wisely, a Roth IRA will help you maximize growth, something that our next account will help with too. 6. Taxable brokerage account. The taxable brokerage account is what you turn to once you've maxed out your tax-advantaged retirement accounts or are saving for other goals before retirement, like a home purchase in 5 to 10 years. It has no limits, no contribution limits, no income restrictions, and no withdrawal age requirements. You can usually invest in whatever you want too. Stocks, bonds, mutual funds, or practically anything. The trade-off is taxes, because what you earn on interest and dividends is taxed each year, and anything you sell at a profit has capital gains tax. Still, taxable brokerage accounts will let you maximize the growth of your extra savings, or can be used for early retirement planning, funding big purchases, and simply building wealth with complete flexibility. You can open one at a brokerage like Fidelity, Schwab, or Vanguard. And many brokerages that offer taxable brokerage accounts offer another special type of account too, which is the more recent and less well-known account that I mentioned at the beginning of this video. 7. Cash management account, or CMA. A cash management account, or CMA, is like a hybrid checking and savings account, usually offered by investment companies like Fidelity or Vanguard and robo-advisors like Wealthfront. CMAs aren't bank accounts, but the ones we've come across have all been FDIC insured, so be sure to look out for that if you're considering a CMA. Cash management accounts let you earn higher interest than a checking account, usually 2 to 4% at the time of this taping, while including features like debit cards, ATM fee reimbursements, and in some cases, even no foreign transaction fees when you use the card abroad. CMAs are great if you already have a brokerage account somewhere and want to keep your finances under one roof, because it integrates with your brokerage account to let you move money between saving, investing, and spending seamlessly. Cash management accounts have actually been around for decades, with the first one being launched by Merrill Lynch back in 1977. But it took many years before firms like Fidelity, Vanguard, and Wealthfront popularized CMAs for the more general public. As I said earlier, cash management accounts have been gaining more attention recently, and may be worth having a look at if you want to combine convenience and higher earnings. My parents are actually testing out Fidelity and Vanguard's cash management accounts at the moment, so drop a comment below if you're interested in a deep dive on either one of them. So these 7 accounts, the checking account, high yield savings account, 401k, HSA, Roth IRA, taxable brokerage account, and CMA, all combine to form the basis and tools for a strong financial future. Start with the basic accounts, and layer more on as you travel along your financial journey. The earlier you set them up and start using them to save and invest, the more time your money will have to grow. By using each account right, a checking account for daily banking needs, a high-yield savings account for emergencies, a 401k and a Roth IRA, and maybe even an HSA for retirement, a taxable brokerage account for flexible investing, and a CMA to earn more with convenience, you can set up a system that makes the most of each dollar and allows for safety, growth, and flexibility. So which of these accounts do you already have? And which ones are you going to open next? Drop a comment below to let us know. Make sure to like and subscribe if you enjoyed today's video. And check out this video here if you want to learn more about the different levels of wealth in 2025 and how you might be able to move on to the next level. Thanks for watching, and we'll see you again soon.